Welcome back to Price Action Trading Series from Market Secrets. This is episode 35 of the series, and in this episode, we are going to learn how to choose the time frames for trading. Before we head into the session, I have one request for you. In addition to the price action trading, we have multiple other learning series running in parallel on algo trading and trading strategies. So do check it out when you are free. All these are available in our website, which is www.marketsecrets.in. In addition to that, we have been providing multiple data feeds for our users. So if you are interested, do check those out as well. If you are an active trader, it will come in handy while you are trading. So with that note, let's jump into today's session, which is on choosing the time frames to trade. It is imperative to select the correct time frames when choosing the three periods that we talked about in the previous episodes. Clearly, a long-term trader who holds the position for months will find little use for 15-minute, 1 hour or 4-hour charts. At the same time, an intraday trader who holds the position for hours and rarely longer than a day would find little advantage in daily, weekly, and monthly combinations. This is not to say that the long-term trader would not benefit from keeping an eye on 4-hour chart or the short-term trader from keeping a daily chart in the selection. But you can see how it is all relative to what you want to achieve. So, in order to improve the odds, you need to put everything together. When all the three time frames are combined, you will easily improve the odds of success for your trades. This is regardless of other rules are applied or not. Performing the top-down analysis helps you to trade with a larger trend, which is what we refer to as the bigger trend. This alone lowers the risk as there is a higher probability that price action will eventually continue with a longer term trend. The confidence level in a trade should be measured by how the time frames lined up in the top-down analysis. For example, if the larger trend is up and the medium and short-term trends are heading lower, taking shots is not the good idea. You should be cautious with your profit targets and stops if you decide to take a short side trade. Alternatively, you may decide to wait until a higher time frame demand area has been reached before you decide to join the longer term uptrend. This is how you should decide on whether you should be taking a specific trade or not. You need to do a top-down multiple time frame analysis. Everything will become more clearer as you progress further through the topics. Here is a simple multiple time frame analysis results. So in this table, we have two trades and we have the three time frames that we use for our analysis. 15 minutes is your entry time frame, 1 hour is your medium time frame, and this is your long-term time frame, which is 4 hours. So let's take trade 1. If you take the analysis results of the trade 1, in this case, in 4-hour chart, the trend is up. In 1-hour chart, the trend is down. So in this case, the price had lost the momentum in the 1-hour time frame and it is either in consolidation or in a downtrend. So we need to wait for the price to realign with the 4-hour time frame uptrend at the 4-hour time frame demand area. So in simple terms, you should not take any long side trades in 15 minutes chart because the 1-hour chart is down. It is in a downtrend. So what you need to do is you need to wait until a demand zone in your 4-hour time frame is hit. So if the price hits any demand zone that is in the 4-hour chart, and at that time, if the trend in your 4-hour chart is still up, then you can take a long side trade in the 15-minute time frame. So again, even though you're using a 4-hour demand zone area, you should look for level within those levels in your 15-minute time frame and you need to take a trade over there. So this is how you need to trade if these kind of trends are available in your chart. Now let's take trade 2. In the trade 2, the 4-hour time frame and 1-hour time frame has the uptrend, but the 15-minute time frame has the downtrend. So 15-minute time frame has lost the momentum. It is either in consolidation or in a downtrend. In this case, we need to wait for the price to realign with the 4-hour time frame and 1-hour time frame's uptrend at 1-hour time frame demand zone, because 1 hour is the closest time frame in the uptrend. Okay, so 1 hour is the closest time frame which has the uptrend still. So you need to look for nested 15 minutes zone within the 1 hour and 4 hour time frames for your trades. So in this case, since 15-minute chart is down, you cannot take any upside trades on the 15 minutes chart demand zones. So you need to wait for any demand zones in the 1 hour chart, and you need to look for the nested zones at the 15-minute level. So you need to wait until the demand area in 1 hour chart is hit, and when that happens you need to look for nested demand zones at 15-minute level, and you need to use that to take the entry. So in simple terms, for these two scenarios, for trade 1, you need to look for the demand zone at the 4-hour time frame, which is nested with the 15-minute time frame to go long. And for trade 2, you need to look for the demand zone in the 1-hour time frame nested with the 15-minute time frame to go long. So the updated table would look like this. So the data are still the same, but you will be taking trades only the demand zone in this particular 4-hour chart is hit for your trade 1, and when it comes to trade 2, you will wait until any demand zone in the 1-hour chart is hit. But in both the cases, you should not directly use the demand zones in 4-hour and 1 hour. Why? This will widen your stop loss. That is why you need to look for any nested demand zones at 15-minute chart, and you need to use those to make the trades. This might look complicated, but watch this video at least 3, 4, or 5 times so that you will be able to understand it better. Also, you will need the understanding of all the earlier episodes to put all these together. So if you haven't watched any of the previous episodes, or if you have lost touch with all the contents in the previous episodes, please do watch it once again so that you can put all of this together. This is very, very simple concept, but it might look complicated at first. That's what I would say. So watch it again and again so that you will get a proper understanding. So this is where and exactly how you should be using the multiple time frame analysis. And with this, we have come to end of this episode. If you have any queries, comments, or feedback about this episode or this series in general, or any other series that we are running parallelly, please let us know in the comment section. We'll be happy to answer and address it. Also, hit the like button if you have liked this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Always remember, your feedback is important for us, and that's the motivation factor for us. So please do provide the feedback so that we can get motivated to deliver more and better content for you. I thank you once again for taking time out of your day to watch this video. I really appreciate it. Thanks for watching. Have a great day. Goodbye.